Good morning, everyone. Thank you for joining us for our Quantum Sparks class today. It's a little bit different than our past Quantum Sparks because we're going to dig a little bit into strategies, real estate strategy. Today's about finding abundance in the void, depreciation, tax, and estate strategies for agents. Now, most agents are trained to think of their value in three ways: showing property, marketing property, and negotiating transactions. But the truth is, that's just the baseline. That's what every agent does. The agents who truly create abundance are the ones who know what others overlook. That is the rules of tax, depreciation, capital gains, 1031 exchanges, and estate planning. These are the tools that transform you from simply being another real estate agent into being a trusted wealth advisor in your client's life. Real estate isn't just about bedrooms and square footage. It is about wealth transfer, legacy, and income planning. When you understand depreciation and recapture, when you can explain the power of step up in basis or how seller financing changes the tax equation, you suddenly become part of the conversation with CPAs, attorneys, and families planning their estates. You stop chasing transaction and you start building a lifetime of clients. In this session, we're going to cover why fully depreciated properties represent one of the largest untapped opportunities in real estate, how to explain in plain language concepts like recapture, step up in basis, and installment sales, and ways to position yourself as more than a salesperson, as someone who helps clients think about taxes, wealth, and legacy. This is how you find abundance in today's market, by stepping into spaces where other agents don't go, and by giving clients insights that shape not only their next transaction, but their family's entire financial future. So let's talk about finding abundance in the void, turning depreciated properties into a book of business. As always, knowledge is only potential. The real power is action, it's execution. So make sure you have a pen and paper, especially for today's program. You're going to want to take some notes. After today, we're just covering baseline on beginner's knowledge of just a couple of topics that can be life-changing to your business. So we're going to do baseline, but when you leave today, take the information and go expand your knowledge. Have coffee with a CPA, some wealth advisors, and take this knowledge into your business for a new way to fill the void in your business. So as always, we start today's program with a quote: "Vision is the art of seeing what is invisible to others." As you navigate a changing market, this is going to be your superpower. Your superpower is just seeing what other people simply don't see. And specifically, once you see what other agents aren't seeing, how do you convey that knowledge onto people who really need it? Okay, let's talk first about scarcity thinking. So the market has shifted a little bit this year, and when you think of things as in terms of scarcity, in other words, there's less business this year than there was the previous year, then you end up creating an energy of scarcity around you. It's really hard to attract abundance when you are thinking in terms of scarcity. Now, if you're focusing on scarcity, you're probably focusing on the same deals that everybody else is trying to get within your market. So competition can feel fierce, leads can feel scarce, but all that scarcity is truly an illusion. It really just means that you're looking for business in the wrong place. Now, in quantum theory, there is this idea of the void. The void is not empty. It's a field of potential energy. So I want you to think of your real estate business like this. If your business is off a little bit from where it was last year, there is a massive amount of potential waiting for you within that void. We're going to talk about how you can convert some of that potential into business and abundance. In real estate, the void is your overlooked opportunities. So today's about shifting perspective, creating new business streams where others don't even see the opportunity. We're going to talk today about uncovering fully depreciated properties. Don't worry, I'm going to go through all the baseline on this, on what it all means and how to turn it into business. We're going to talk about framing tax problems and seller financing solutions, showing sellers how to turn a tax bill into income, and building a book of investors, or maybe even building some wealth for yourself. So where do most agents kind of draw the line as far as going out and getting business? Most agents, like I said at the beginning of today's session, they draw the line. They know that they are in the business of showing properties, marketing properties, and negotiating transactions. But that's kind of what clients expect. That's what every agent does. But that's not where the abundance will lie for your business moving forward. Your abundance lies in turning the void, the space left from the changing market, turning that into new business. The void is untapped potential, untapped knowledge, taking information that exists in the world and turning it into energy that creates business. It creates wealth for clients on both sides, buyers and sellers. So very few agents understand tax planning and estate strategies around real estate. Tax planning and estate planning all depend highly on depreciation. So we're going to talk about, why do investors love to buy real estate? And one of the biggest reasons is, not only does real estate appreciate traditionally over time, the longer you hold it, the more likely it is that your property will continue to appreciate, but also depreciation. That is the tax benefit of owning investment property. So when you can explain these concepts to a seller and to a buyer, you're no longer just selling houses. You become a person that can solve problems of the wealthy. You become a person of authority in your business. You become that person of authority because you bring knowledge to the table that others simply don't have. This means that you become invited into conversations with CPAs, attorneys, and financial planners. You become part of your client's long-term wealth and legacy planning. And because of that, your value rises far beyond the transaction. You're no longer just pitching real estate. You become an advisor. So by stepping into the advisory role, you unlock opportunities that other people can't see. You attract investors, heirs, and families who value your guidance, and you build a book of business rooted in trust, repeat business, and referrals. Your knowledge of a very simple concept of depreciation can transform you from just a real estate agent into a legacy advisor, a financial strategist, an asset planning advisor, capital growth advisor, a real estate wealth strategist. So let's dig in and talk a little bit about investment properties and depreciation. So one of the big reasons why a person who has money laying around wants to invest in real estate is, like we said, number one, the property will likely appreciate over time. The longer they hold on to the real estate, the more it'll appreciate over time. But also because of something called depreciation. Depreciation shields some of the income that the investor makes on their property. So here's a number for you. These are just, let's say somebody buys a $1 million rental that's producing, let's just say $10,000 a month, and it doesn't matter so much what the property's bringing in per month for what we're examining today, because we're strictly talking about depreciation. But let's just say somebody buys $1 million property and it's making $10,000 a month or $5,000 a month. At this point, it doesn't matter because we're going to discuss what the depreciation shield does. On a $1 million property, the annual depreciation is going to be around $36,000 a year. That's not 100% accurate because when the investor buys a property, not 100% of the purchase price, not 100% of the market value of that property is depreciable because a portion of that purchase is land. So a portion, and this varies by state, but let's say 10 or 15% or 20% of the value of the price that is paid for the investment property is going to be allocated to land, and the land doesn't depreciate. The land keeps its value over time because nothing can depreciate on land. So, but for our purposes today, we're just taking the lump sum and examining it that way just to get the core concept of depreciation. So on $1 million on a residential property, they can depreciate that over 27 and a half years. So you take $1 million divided by 27 and a half years, and you have $36,000 a year that is sheltered from paying taxes. So for example, if this property grosses $120,000 a year in rental income, right off the bat, 36,000 of that income is not going to see taxes. That is depreciation. By the way, there's going to be other expenses as well, such as like property taxes, things like that, insurance. There's all kinds of other expenses that go into running a property. But right off the bat, 36,000 is shielded from income tax. This here is why many people buy investment property, because here they're getting $36,000 a year that is not taxed. However, there's a caveat to that. The caveat is eventually they're going to pay the price for that. When they go to sell the property, there is what is called a recapture of depreciation. And we'll talk more about that in a second. But for the time being, the owner reports 120,000 minus their 36,000 in shielded depreciation means that for 120,000 they bring in, they're only paying taxes on 84,000, and that's before they expense other items. So depreciation reduces yearly taxes. However, it's only a deferral of those taxes. When the property owner sells the property, all that depreciation gets recaptured and taxed. So what this means is over 27 years on a residential property, and it's over 39 years on a commercial property, but on a residential property, investment property, over 27 years, $1 million on this property is going to be shielded from taxes, that they're not going to have to pay income taxes on that $1 million. But what does this deferral mean? This means that when they do go sell the property in 30 years, that the IRS says, okay, we protected $1 million of your income on that property. We shielded that for the last 27 and a half years. So when you go to sell the property now, there's a recapture of the shielded tax. So let's look at some numbers on all of this. Okay, my screen just froze. All right, let's go backwards. Okay. So depreciated properties, I'm going to come back and go through numbers again, and then we're going to talk about how you can help your seller who has a fully depreciated asset. That means they've owned it for 27 years on residential and 39 years on a commercial, how they can actually sell the property and shield their recapture as well. In other words, reduce or avoid recapture when they go to sell. So on depreciated properties, on residential, they can depreciate over 27 and a half years. On commercial, it's 39 years. And once it's fully depreciated, there's no more tax shelter. So this means that if somebody owns their residential investment property for more than 27 and a half years, that all the income that that property is generating, there's no more depreciation advantage. None of that income is being shielded anymore because they've owned the property for too long. This is information that can change your business. You can make an entire business of going out and finding people who've owned their residential investment properties for more than 27 and a half years, or even if they're close, maybe they're at 25 years or 24 years, to educate somebody who doesn't realize that they have a property they should be doing something with, because their reason for originally having the investment in real estate is now gone. There's no more depreciation for the property. There's no more shielded income for that property. So once the property is fully depreciated, there's no more tax shelter. And remember that the land portion of it is not depreciable. So, if somebody owns a property for, let's say, 2 years and 3 years, let's say somebody buys a $500,000 property and they sell it after 2 years, there's also a recapture because they got that tax shield for 2 years. So they will have to pay some of that depreciation. They will be taxed on some depreciation shield because they had a shield for 2 years. But at 27 and a half years, they've taken all depreciation. So there's a huge depreciation recapture. So selling a multifamily after 2 years on a $500,000 transaction, they would have taken about $36,000 in depreciation. So their recapture, which is 25% federal, and state will vary state to state. But for somebody that has bought an investment property in the $500,000 range and has owned it for 2 years, when they go to sell the property, they're going to pay about $9,000 just in recapture. That does not count that they will also have to pay capital gains tax. So this is assuming that if they bought an investment property at 500 and sell it for 500 in 2 years, even with making no appreciation, they owe $9,000 in taxes because of the recapture. Most likely, they will also have capital gains. In other words, if they sell the property for 500 and then sell the property for 600, not only do they pay $9,000 for depreciation recapture, but they're also paying capital gains. Now, let's look at that same property, a $500,000 property, 27 and a half years, fully depreciated. Over the 27 years, they've taken the full $500,000. And so now, when they go to sell the property, this is for a $500,000 house, they owe $125,000 in recaptured depreciation. So that's 25% of their full depreciation, which is $500,000. That is not including their capital gains tax. So this property owner now owes $125,000, and in addition to that, they're going to have capital gains tax on top of that. The reason all this matters is because it's a pain point that investors need to be aware of. If they sell outright, they have a large tax bill up front, even without capital gains. And we all know that anybody who's bought real estate in the last 5, 10, 20, or 30 years, there's also going to be a massive capital gains on the property as well. So they're paying their capital gains tax and they are paying for their depreciation recapture. Don't worry, I'm going to get to how you can turn this into business for yourself. The solution is that when a property owner comes to you and they've owned their property for a really long time, meaning it's mostly been depreciated, the property has been either almost fully depreciated or has been fully depreciated, there are ways that they can sell the property and continue to avoid paying the recapture. And they can also potentially avoid or kind of kick the ball forward, not pay those capital gains tax just yet. And by having this information and knowing how to utilize it, you can go identify these owners by going into your MLS, into the public records, and looking at property owners who have bought multifamily investment properties 25 years ago. Anything over 20 years, they're getting close to the end of their depreciation recapture. So you can you can create business. This is so much better than just waiting for a buyer to come to you who's ready to buy their first home. Of course, we're always going to have that business as well, but this is about creating business that doesn't exist, reaching out to a property owner that doesn't know the tax consequences of waiting and just selling their property outright. So what we're going to go through is a scenario where you reach out to a property owner who has a fully depreciated or almost fully depreciated property, meaning they've owned it for 20 plus years. And you are going to reach out to them and tell them how they can defer their recapture tax, they can defer their capital gains tax, and create a pension-like income so they can still have income coming back on their property. At the same time, it's going to give you an opportunity to build a buyer pool of buyers who are interested in buying real estate or buying their first investment, but maybe don't have a 20 or 25% down payment that is typical when they go to a bank for their first investment property. The number one reason why more people don't own investment property is because of the down payment requirements on investment property required by conventional institutions like banks. It is typically 20 or 25%. And the best part of this is that you create a business, you create income where none existed before. There are millions of residential rental and commercial properties in the US that are the owner has owned the property for more than 30 years. These are always fully depreciated. Many of these properties are paid off because they've owned the property so long. It had a mortgage at one time, but it's now paid off. So that means that they don't have mortgage interest deduction. They now no longer have their depreciation shield. And so these property owners are paying a lot of tax to keep these properties. And you've got an answer for that. This is a massive untapped pool of opportunity, and there is business hiding in plain sight. Why is this unique? Well, number one, we have the advantage of having easy access to public records, and property purchase dates are public. So you can target owners whose properties are fully depreciated. Second of all, you have the opportunity to reach out to those property owners and awaken a seller. Turn a property owner into a seller. In other words, these might be people who aren't even thinking of selling, but you bring them a solution that they didn't know that they needed. And this is a proprietary pool because other real estate agents aren't focusing on it. Other real estate agents are going after the conventional stuff that every real estate agent is competing for. These transactions have very little competition. And then the other upside to this is that because you are educating an owner about something they didn't realize, you end up owning the relationship because you become their savior, their educator on how to turn their property that has no more tax shield into either a pension-like income or trading it into another property. By the way, you can also buy these properties because we're going to talk about how you're going to help this property owner. And it all comes down to turning the sale of their property into an installment sale. So a property owner that's owned their property for 30 years, if they put that house on the market and sell it just like any other property, where a buyer comes along and the buyer gets their own financing, then that seller is going to have a massive tax liability, a massive tax liability. They're going to pay the capital gains, 15% plus on the gain that they've created, but they also are going to get taxed on the depreciation that they've taken over 27 and a half years. So there's a massive tax liability. So what you're going to educate the owner on is the possibility of them selling the property and financing the property for the next owner. So they become the mortgage holder for the next owner of the property. So we have real estate agents who have actually bought many properties this way, where you educate the seller to say, hey, we're going to sell the property, but you should hold the mortgage on this because now you're getting a massive amount of interest over time. And that turns the sale into an installment sale. In other words, because they're not getting all their lump sum income up front, they will have to pay their recapture, by the way. And I'll talk about that in a minute. The recapture will always have to be paid in the year the property is sold, but they defer the capital gain piece of it. And we'll show you what this looks like and how they can make enough income from just being the mortgage holder. In about 3 years, they can make enough from being a mortgage holder at a 7% interest rate that they collect what they had to pay out for recapture, and they also collect enough to pay for their capital gains tax. So they get all of that within a 3-year period, roughly, at a 7% interest rate. Or they could actually flip it into another property. But let's look at both scenarios. So this is an opportunity for you as an agent to also potentially buy property. So let's say, for example, I looked up in Massachusetts, if somebody bought, let's say somebody is buying a multifamily residential property right now in Massachusetts, they're probably going to pay somewhere around $1 million. So I looked up statistics to see if somebody is paying $1 million for a multi now, what did they pay for that property 25 years ago? 25 years ago, they would have paid about $375,000 for the property. So now when they go to sell the property, first of all, immediately they're going to be taxed on $375,000. This is not quite accurate because you also have land built into that, but just for our purposes, let's just say they took the whole thing as depreciation. So that means that right off the bat, when they sell this property, they're going to get taxed on $375,000 because of the depreciation. But today they're going to sell the property for $1 million, and they're going to finance the property. So they're going to become the mortgage holder on the property, and they're going to finance it at 10% down on a 20-year note at 7%. So they become the mortgage holder. So right off the bat, they're going to owe their depreciation recapture when they sell the property. This is even if they hold money on it. So they're going to owe taxes on $375,000, but also what they're going to defer is they don't have to pay yet the capital gain tax of 15% for the appreciation of the property. Now, let's look at it. If they sell this property outright, they are going to pay $187,500 in tax. That's $93,750 on depreciation recapture. Again, not 100% accurate because land is, we have to work in land, but say $93,750 just on recapture, plus they have capital gains of $93,750. So that's if they just sell the whole thing outright cash right now. Or B, they could finance it. That means that they hold a note for $900,000. So they hold a note of $900,000. The new buyer assumes a payment of $6,900 a month at 7% interest at 20 years. And if the buyer keeps that mortgage for 20 years, your seller just made $774,000 in income. So when they sell the property and take the note, they owe recapture $375,000 is taxed immediately, which is the $93,750. They're going to owe 93,750 right away, but they're also collecting some money up front from a down payment from the buyer. Now they also are going to have capital gains still of another $93,000, but that's going to be over the time that they receive the principal. So they don't pay that up front because now they're only getting little chunks of principal each year. So they push the tax off that they just pay a little bit of that $93,000 each year over the installment. But in addition to that, they're also now making interest on the property. So what is the recapture where they make enough from the mortgage to, number one, get their 93,000 for the recapture and another 93,000 for the capital gains? In other words, how long does it take on this note for the seller of the property to make $187,000? And the answer is 3 years. So once the seller of the property has had that note for 3 years, they will have made $187,000 on it, meaning that washes what they owed for recapture. It washes what they owe for capital gains. Now, of course, they're still making ordinary income because they're now a mortgage holder. Now, what about aggravation of doing all this? Well, first of all, the property owner no longer has the aggravation of holding a property and doing repairs and taking phone calls because something is not working and doing general upkeep. The property is no longer there. Somebody else owns it. What about the aggravation of servicing a mortgage? Well, there are companies that'll do it for like hardly any money. Like they can pay somebody. These companies like Evergreen Note Servicing, Madison Management, Phase Servicing, they take like 20 or 30 bucks a month and they handle it all. So the property owner doesn't even have to deal with that. And this is the best part. There's no risk for the seller because if the property owner defaults, the seller ends up getting the property back through a foreclosure. So how do we find these sellers? Public records, CPAs and attorneys. Like these properties exist everywhere. And what do you say to a seller? Hey, have you considered how to spread out your tax liability and turn it into retirement income? Not only that, how do you find buyers? Well, it's super easy to find in people who want to invest in real estate but don't have a 25% down payment. In fact, you could host seminars for investors on how to do this, how to go buy properties. In fact, you can host seminars showing buyers how to do this and let the buyers go do the legwork and call you in for your expertise. So you're making your commission on the transaction. Why do investors love it? There's no banks. It's a low barrier to entry, and it's a way to build a massive portfolio without having to put 25% down every time they want to buy a property. So the sellers get income over 20 years. They can put off paying capital gains. The buyer builds assets, and you become a trusted connector. The other thing to know about depreciation is if the property owner has owned the property for a really long time, they have no more depreciation on the property. So maybe they don't want to sell the property and hold a mortgage note. Their other option is to do a 1031 exchange. In other words, they can go exchange the property for a more expensive property, which will get them higher rents, but it will also get them depreciation again. Now, if they trade their property, let's say that their property is fully depreciated and it's worth $1 million. If they go buy another property that is worth $1 million, they're not going to get the benefit. But what happens if they go to a more expensive property? Then they can get the benefit of the depreciation again. So they could go to a $1.5 million property, and there's an excess basis there. So now they have another $500,000 in depreciation that they can write off over the either 27 and a half years for residential or 39 for commercial. So exchanging into a higher value property gives them a depreciable basis that they wouldn't otherwise have on their property that they've owned for too long. So all of this is stuff that information that you can turn into this could be an entire career's worth of transactions, that this becomes your specialty and you're no longer competing with just the same buyers and the same sellers that every other real estate agent is focusing on. You become a wealth advisor, an estate planner, helping people understand what the implications are for holding a property for too long. So this is a quantum reminder that abundance in the void isn't about chasing what everyone else is chasing. It is about knowing something that other people don't, teaching what other people can't teach, and becoming indispensable in wealth conversations where many real estate agents are just never invited. So that's kind of a baseline on understanding depreciation, but by all means, I broke it down into like very raw numbers. It is worth the time and effort to go get educated on the 1031 exchange and how depreciation affects a property owner at the 20 or 30-year mark, where they no longer have the benefit of shielding income. As George Bernard Shaw says, don't wait for opportunity, go create opportunity. And as always, you can go watch previous versions of Quantum Sparks at laerrealty.com/Quantum Sparks. And if there's ever anything you wish for us to cover in a future program, go to laerrealty.com/ask anything. Thanks, everyone.